hey, magnificent, hey, magnificent, hey, magnificent, hey, magnificent, hey, magnificent, hey, magnificent, hey. The last episode taught us how to read an earnings release. Now we're going to learn how to value a company, because share price and value aren't always the same thing. A business is worth the cash it can generate over time. It's that simple. Keep it that way. Stop staring at the stock price to see what the market feels every second. Focus on what the business is actually worth. The valuation model we'll use is pretty straightforward. We'll value the operating business, add the strategic assets, subtract the claims ahead of common equity, divide by shares, then if it deserves it, add optionality as a separate layer. So let's use this model and apply it to GameStop following their record-breaking Q1 2026 earnings release. During this quarter, GameStop reported $143.3 million in operating income, $8.4 billion of cash equivalents, and marketable securities, $369.6 million of digital assets and related receivables, $983.3 million of collateral pledged for the derivative asset in eBay, $4.17 billion of long-term debt, and 448.3 million common shares outstanding. So first step, value the operating business. We need a reasonable estimate of normalized operating earnings and a reasonable multiple. GameStop's operating business isn't distressed anymore, so it shouldn't be valued like a distressed business. The company is profitable, much more lean, and coming off of its strongest first quarter ever for operating income. It deserves to be valued like a functioning business, not a dying meme stock. So for this model with GameStop coming off of a record quarter, I'm going to dial back that pace and normalize operating earnings at about $300 million annually. Then add a 15x to 20x multiple, and that gives you an operating business value of $4.5 to $6 billion. Next, we add the strategic asset base of $8.4 billion of cash equivalents, and marketable securities, plus $0.4 billion of digital assets and related receivables, plus $1 billion of collateral pledged for the eBay derivative asset. That gets you $9.8 billion of strategic and liquid assets. So now the math is $4.5 to $6 billion operating business value plus $9.8 billion asset value for a total of $14.3 to $15.8 billion gross value. That's what the company is worth before you deal with who gets paid first. Next, we subtract the claims ahead of common equity. GameStop has $4.17 billion of debt tied to their senior convertible notes. It's free cash borrowed at a 0% interest rate and due back in shares or stock in 2030 and 2032. So $14.3 to $15.8 billion gross value minus $4.2 billion convertible notes equals $10.1 to $11.6 billion current equity value. That's the equity value before optionality. Now divide by shares. GameStop has 448.3 million common shares outstanding. So take that 10.1 to 11.6 billion and divide it by 448.3 million shares. That gets you $22.50 to $25.90 per share. That's the clean core value. And if this was a typical retailer, you could stop there. You would have a usable framework that already teaches most of what valuation is. Value the business, add the assets, subtract the senior claims, divide by shares. But with GameStop, upside needs to be factored in because it's not a typical retailer with a predictable forecast. That's when you apply optionality. Optionality is a probability-weighted future upside beyond what's already visible in the current business and current assets. The clean way to estimate it is to start with the capital base management can actually deploy, then assign a reasonable incremental return and evaluation multiple to that added earnings power. For GameStop, I'm using the $8.4 billion liquid asset base. That's the value I'm assigning to the possibility that management creates something more than the current operating business and asset base already imply. On the low end, a 5% incremental return on the capital creates about $420 million of added annual earnings power, which is essentially the passive net income GameStop already returns by letting the cash sit. Put a 7x multiple on that and you get $3 billion of optionality. On the high end, a 7% incremental return creates $590 million of added annual earnings power. Put a 10x multiple on that and you get $6 billion. So now the math becomes 10.1 to 11.6 billion core equity value plus 3 to 6 billion optionality, which equals 13.1 to 17.6 billion total equity value. Then divide that by the same 448.3 million shares and you get 29.20 to 39.30 per share. So now you have two answers. Core value is 22.50 to 25.90 per share, and strategic value with optionality is 29.20 to 39.30 per share. As of recording this on June 12, 2026, GameStop is trading below the low end of core value and at a meaningful discount to the low end of strategic value with optionality. So that's the model. It's an easy process for turning a business into a value range, and you can apply it to almost anything. And once you have that value range, compare it to a stock price and ask the only question that really matters. What is the market missing, or what am I missing? Because the market doesn't have to agree with your valuation anytime soon. So don't just measure the gap. Understand the story that's causing it. Like, subscribe, follow @TheMagnificent on Instagram and X, and let's keep the education going every Sunday at 11 a.m. Central.